Welcome back, everyone. The purpose of this video is to provide you with a very easy and clear understanding of how to choose an options contract. And this is one of the most critical things for you to learn because, of course, if you don't choose the right contract, even if the stock that you're dealing with goes in your direction, you're not going to make any money. You're not going to realize any gains. So let's get right into it. And this is designed for beginners and intermediate traders just to have a good understanding so you could jump right in. Choosing the absolute perfect optimal contract and having more advanced situations is beyond the scope of this video, but this is going to be very helpful to your overall trading. So what you see in front of you here is an options chain, and this is on Apple. And I'm just showing you what it looks like in Interactive Brokers. I know a lot of people use different brokers. I wanted to give you a look at Interactive Brokers. The quick spiel on that is that I prefer Interactive Brokers for executions, for actually placing trades, because it is extremely quick. And I'm referring to Interactive Brokers Pro. There's none of this payment for order flow delay where it lags and then you don't get filled and you click a button and you watch the price run away. That happens with all sorts of different platforms. So I highly recommend using Interactive Brokers for executions. And the link to at least check it out if you're just curious, it's in the description of this video. Click on it, go check it out. The executions are lightning fast compared to most other platforms in my experience, and that only pertains to Interactive Brokers Pro because I know they have a light version. Not familiar with it, and I don't think it yields the same kind of performance. So if you are already using it, I know a lot of people are, this is the options chain. Just a reminder that you can click here, and you can configure your options chain to show you different options, different headers here, different columns. And so I know a lot of people use Thinkorswim. I'm actually going to pull that over now. I'm going over to that window, and here is Thinkorswim. So I'll explain it for you guys here just because I know that at least right now there's a few more people using Thinkorswim. So maybe that'll change. Let's take a look and see what the things are that you need to understand. So when it gets to options, there are a lot of different things that you could look at, and it gets pretty advanced. As you can see here, I have that's the last price, net change, the delta, open interest volume, theta, bid and ask. And to me, that is what everyone needs at bare minimum. You can use those to make very good decisions. Now, we could introduce things like the gamma and the vega, but I think for a lot of people, particularly in real time, that's not as effective, it's not as helpful. And if you're not using something, get it off your screen. Whatever it is, you're not using it, get it off, right? There's already so much information flooding you when you're in the trading day. Don't have information that you don't have a use for. If you're not using it, don't have it in your view. It's just going to add noise. And what you're looking for when you trade is you want signals, not noise, right? Noise clouds signals and makes it difficult to understand. And there's so much going on that it can already rattle the best of traders. Why overwhelm yourself like that? Okay, so this is what we have here. And let's just talk about some of the basics. So we're looking at this, and this is for July 22nd, okay? That means that's the expiration date. That's when these expire. You know, I can sort of bring this down and we see a plethora of different options. We're going to stick to July 22nd. It's just one that we're choosing randomly. But you can go forward. If you're looking for later expiration dates, you can go forward and look at all of these different dates. Depends on what kind of trade you're placing. If you're trading weekly, and we'll talk about why you might do that, you'd be looking at the 22nd. But if you're going for swing trades, you tend to push out a little bit further depending on your strategy and what you're expecting, right? And we'll get into that. But so we're working with weeklies here, and we want to talk about it. We know the last price, net change, that's all really basic stuff. Delta is what a really important thing that I want to discuss, and you can have some advanced strategies. You'll notice that on my Twitter when I place call outs and I explain them, I move around a little bit, so it's not going to be as cut and dry as what you might understand from this video, but that's the point, is that I want you to get to a point where you're comfortable and you could use basic information. I start to slide out based on my projections, but we'll stick to using the delta for the purposes of this video, and let's just get a very basic and clean understanding of it. And you'll see some mixed data here. Essentially, what the delta tells you is that for every $1 change in the underlying, that's Apple. So Apple stock was at $150.17 on close. That was on Friday, July 15th. Okay. So for every dollar move, and this is the call side, this is the put side, right? You see puts here, see calls here. Every $1 move is going to yield a 34-cent change in the options contract, right? So we're at 150.17, right? If it goes up to 151.17, here is the bid and ask. Let's just assume that we were at 115 was the last price, right? Because we'll talk about the bid and ask and spread later. We're going to see that increase by roughly 34 cents. Is it exact? No, because there's implied volatility, of course, and you have bidders and you have people asking, buyers and sellers, and they come to a meeting point in between. But this gives you a general idea of where you're going with a $1 move. This is all based on a $1 move, right? So what happens is as you go deeper into the money, this number is going to go up. What do I mean by deeper into the money? Well, right now, this is a 152.50. It's out of the money. You know, we talk about intrinsic, extrinsic value. I'm not going to confuse things with all sorts of complex terms or terms that you're perhaps not used to. But the point is that if this expired, it wouldn't really be worth anything to give yourself the right to buy at 152.50 because that is out of the money, right? The stock's already less than that. So why would you care to have a contract that lets you buy at 152.50 when you could just go to the open market and buy at 150.17? That's out of money, right? But as we go into the money, 150, there's 17 cents of what we would call intrinsic value. And you're starting to go into the money. So as you go deeper into the money, you'll see that the delta increases. And the maximum it can increase to is 1.0. What does that mean? 1.0 basically means that for every dollar that the underlying stock goes up, right? Like if this goes 150 to 151.17, that's a $1 increase. Your options contract will increase by $1. It's now moving completely in sync with the underlying. And as you go out of the money, right? Like let's say 170, or let's bring it in a little bit closer for Apple. Let's say 157.50, or 155. That's a little bit better for us. It starts to decrease, right? And as you get further away, it decreases even more because it's less likely this is going to happen. 150.17 for a stock like Apple, a monster stock like Apple, very unlikely that by July 22nd, today is, July 16th, the Saturday, very unlikely that by the end of this week we're going to reach this price. So you don't have a lot of price sensitivity on the delta. Generally, what's going to happen is if you want a higher delta, you're going to pay a higher premium. See how the premium cost goes up? And if you go lower, because there's less price sensitivity and it's far less to happen, people are selling it at a lower cost, right? So if you look at something like the 200s, it's not really even any action here, right? There's 1 cent ask, 0 cent on the bid. Why? Because it's so unlikely that Apple will reach that price by next Friday. In 5 days, Apple is a gigantic company. That would constitute hundreds of billions of dollars in change in the market cap. Not going to happen. Or the probability of it happening is extremely low. Okay, so you want to consider that, right? Because if you're too low, then even as the stock moves, you're not going to see a change in your options contract, right? You want to get something where you can get a move with it. You start to get a little bit closer here. And what are the differences? Let's just use these two to compare. And you can pull up any stock here. We could pull up Microsoft. We could pull up Meta. We could pull up whatever you'd like. And they all vary a little bit, right? So if a stock is more likely to make big moves, you'll see some action on these further out. So looking at these two, right? If you're anticipating a big move in Apple, then it might be wise to make this purchase. Of course, you're going to pay a little bit less for it. Remember, it's because it's less likely to happen. It's less sensitive to price changes. It only goes up 19 cents for every dollar move. You'd probably make a selection here. But what are some other considerations outside of just the delta? And remember, the delta will change. As it goes closer into the money, this number here will increase from 19. It'll naturally go around 34. It'll naturally start moving up as it goes deeper into the money. But what are some of the other considerations? It's not just the delta and the price. Well, you want to see open interest, right? That means there's a lot of these contracts floating around. And you want to see a sufficient amount of volume. Because if you don't have enough volume, even if you have a winning contract, even if you're in a great position, there's no one there to buy. Oh, I just put it simply. There's no one there to buy your stuff. This is an open market, right? So you can get to the market and say, I've got this stuff and it's worth a lot. And everybody agrees it's worth a lot. Great. Who are you selling it to? There's no one here. Okay, so it's worthless, right? You need to have buyers. You need to have volume on the other side. This is a tremendous amount of volume, right? Typically, you can get some liquidity here, and we tie the word volume and liquidity together because they're synonymous. You can get you can find your transactions here. This is really high volume. You're going to be able to sell. It's just something to consider. Now, if you were buying something like the 175s here, you'd have to be very careful because that means only 38 of these contracts traded on the last trading day. That's not a lot. Depends how many you're buying. And one thing that I want to caution traders of is that as you see these lower price contracts, they're tempting because you can get more, you get more leverage for your money if it goes your way. Just remember, if you're buying more and you're holding more, you need to see the volume there so that you can liquidate. What do I mean by that? Let me clarify and go deeper. So 741 traded. If you look at this and say, oh, that's only 2 cents, I could pay $2. Let's just put aside the commissions. And you load the boat and you spend a few $1,000 or a few $100 and you buy, I don't know, let's just say you buy 500 of these, right? And you're feeling really pumped about it. You're like, wow, if there's a big move and it moves my direction, I could sell them for $500. Oh, it's moved up a little bit. I don't see the bids there. Okay, I see someone bidding 2 cents or 3 cents now, and I can ask for 4. And you're thinking, I went from 2 cents to 3 cents. That's a big jump, right? Because it's a 50% move. If you don't have the volume, you can't get out of your contracts. You can't sell those, right? You went and bought 500, but you weren't conscious of the fact that there isn't a lot of volume there. There isn't 500 demand. Like people aren't looking to buy 500. You might have someone, it might show up here where you're up 50%, from 2 to 3 cents, and it's somebody asking for 10. Well, great. You could sell 10 of the 500 contracts you have. You're in a lost position. You're scrambling. And as time pushes forward and we move closer to expiry, unless you see a big move that puts you in the money or gets closer, it's going to end up worthless. So it's just something to be conscious of. You need people there to be able to buy what you're selling. And it's not just the price. The price can get you excited and you could be thinking, whoa, I bought for 4 cents and now it's at 7 and someone's bidding 6. Yeah, but for how many? You're holding 200? Someone's only trying to buy 10? That's not good. Even if you made a little bit of money on 10, the rest of the yours are going to expire as worthless. You want to be careful. So that is why we care about open interest and volume. That is why we care about the delta. And then one other thing I want to talk about. I mention this every single day, almost bar none. When I'm tweeting out, I'm helping people understand. As a reminder to people, I've been an options professional. I became a licensed professional in 2005. I've been at this for 2 decades. Be mindful of not only your volume and open interest, but also of spreads. What am I talking about when I say spreads? Well, this is end of day data, so the spreads are going to be wider, but the spread is going to be the difference between the bid and the ask, right? So when we look at something like this, there's 3 cents there. Think of it in terms of percentage, because 5 cents would constitute about 10%. Let's say we're going to place a purchase, right? And let's say there's a pretty big spread. I'm going to use this example here, right? And you'll see oftentimes lower volume means wider spreads, but that's not always the case. Always double check. So let's take a look at these 145s. What's going on here? I'm trying to purchase. The bid is $5.10, right? So I'm going to pay $510 per contract. Okay, what does he ask? If I want to get in, if I want to be guaranteed to get in right now and make this purchase, someone's asking $6. Let's say I hit the bid or hit the ask, right? That's what we call it. I'm going to give you what you want. Whoever's asking for it, I'll give you the full $6. What's the danger there? The danger here is that immediately my $6, my $600 contract is now only worth $510. What do I mean? How does that work? It's only worth what someone's willing to pay you for it. It kind of goes that way in life for everything. People will, puff you up and tell you something's worth a lot. I could tell you this from having a lot of business experiences. I was a 2-time Inc. 50 CEO. I was appointed by a board. I worked in Fortune 50. When you're doing a business deal, something is only worth what you can find a buyer for, right? Someone tells you that your valuation, your contract's worth $600, right? Let's just say that's your business here. Okay, what is the open market willing to pay for it? $510. Guess what? It's worth $510. Your pie in the sky number is meaningless if that's not what you can get for it. Because if you want to sell this contract, you're selling for, this is the amount that you know you can sell for. Now, amounts are hidden between, right? And I caution people on these wide spreads. Let's say this was $7. You bought in at 7. If someone's willing to pay $5.10 for it, that means immediately, second, you push the button, and within seconds, your $700 contract now, you can only fetch $5.10 for it. Now, somebody might bid higher. You can ask $6.50. You can set the asking price there, and someone might hit it. But you want to deal with certainties. There's enough volatility and uncertainty. You don't want guesswork of like, well, I'm going to list it and hope. I don't like to chase after wide spreads. I see this too big for me, right? Because if, let's say that you're going to stop out on a stop loss at about 10%, you're already down more than 10% here. You're down nearly 20%, right? Because 10% is about 50 cents. Here you're out 90 cents, which is just under 20%. I don't want to be down 20% because now I'm in a hole. And now as the stock price moves up, it just digs me back to the point where I'm break even. Said differently, if we're going to appreciate 84 cents on a $1 move up, right? And all I can get now is $5.10. After $1, I can get $5.94. Well, if I paid $6 and I have to wait for the stock to move up an entire dollar just to get back to the point where I'm at $5.94, I'm out $6 after this big move. And with Apple, a $1 move would be important. So you want to look for tight spreads where you're not giving up a big percentage. This is another great example, right? Lower volume. That means you're buying at $5.20 here. Immediately, the top bid price is $4. So be very mindful of the spreads. And we could understand it clearly here because I say, this is $520, this is $4. But as you move down, be very careful, right? Because this is significant as well. Like when we're looking at 20 and 18, it's over 10%, right? You have to be very careful. And of course, this is an exaggerated example, but it's 50%. So if you bought $200 worth, right, the asking price or the bid price would only give you $100 worth. Be very careful about the spread. So let's go through a recap. You want to look at the delta. That's going to tell you how your stock is going to move for every move on the underlying, every $1. You want to make sure there's sufficient open interest and volume. It doesn't have to be this high, but be mindful of your position size, and you want it to be far bigger. If you're going to be buying 100 contracts, you want to see at least a couple thousand in the open interest in the volume, right? And then, of course, the bid and the ask, you want to understand what that means and know that the only price out there for you that you know of is what the bid is. So if you're going to hit the asking price, just know you bought at 55, someone's only offering 52. Now the last piece here is going to be important for those who are running swing trades. Much more important. If you're trading within the day, unless it's a Friday, Theta is not going to erode you that quickly. And the reality of Friday trades is that anything that isn't in the money, Theta is going to erode your premium. So what is Theta? It's the rate of decay. So that's a big difference with options. Yes, with options, you could put a little bit of money and have a ton of leverage and get these big, huge moves. You can also lose all of your money very quickly. Part of the reason is Theta. That means as time goes on, the value of your contract is eroding. It's decaying. We call it Theta decay. And this gives you a general idea of what the decay is going to be overnight on a one-day basis. So if you're at 115, you're going to be around 98 cents tomorrow. And it's not perfect and it's not exact or applied specifically. That's just the reality of options. There's a lot of things that can vary it, but it helps give you a general idea. Where this becomes important for most traders outside of being later in the week, every day Theta is eating away at your contract, particularly on weeklies, and it ratchets up as the week goes on. For swing traders, you're going to want to have a good understanding of this just to understand how much time you have to go to see your move, right? Because that's the idea with swing trading. If I'm buying, let's say October 21st for Apple, right? You could see that something near the money here, near the money means near the price of the stock, 150, let's say. The Theta's 20 right now. That's pretty substantial. That's just under 10% of the value of the contract, right? Because contract's about 232. We're going to lose minus 20 on Theta. Let's see what it is for a 150, and you'll see the 150s are a lot more expensive. 150, almost 5 times as expensive, and look how low the Theta is. Why is that? It's because we know the reality is that there's so much more time for Apple to make that move, right? so much more time for the stock price to change that I'm going to have to pay a big premium to get in at this price. And Theta is not going to erode it, right? Because when we're performing calculations, we're not saying, hey, it's impossible, Apple's not going to make a move, the value of these contracts are falling rapidly. Whereas each night that passes by, the chance of Apple making a big move is far less on a weekly. So that helps you understand Theta. So let's just do a quick recap with everything that we have here. We have the delta that helps us understand how our stock price will move in tandem, our options contract price, that's here and here, how it will move with the underlying. For every $1 move, which direction we go in. And we apply the inverse here on puts, right? So over here, that means as we go down $1, our premium will increase by 65 cents. On calls, as we go up $1, our premium will increase by 34 here. We have open interest, that's how many contracts there are out there. And we have the volume, how many have been traded. So you can see that there's more volume than there is open interest. That means the same contracts are being traded over and over, about 3.6 to 1 ratio, right? So for 10,000 that are out there, we have 36,000 trades. We have theta, that's the rate of decay, that's the rate at which this contract will fall overnight, right? But again, that's not applied perfectly. It's not like you fall asleep, we close at 115, the market starts, it's at 98. There's a lot of other factors that apply there, just like delta's not perfect. And then we have the bid and the ask, and of course in between those we have the spreads. So hopefully that helps you get a better understanding of what's going to happen with your contracts, how to choose them, and how to move forward. If this video was helpful, please like and make sure you subscribe. Of course, you can follow me on Twitter, Profits Taken. And if you want to learn from me at a deeper level, I go into depth. I provide some of my own personal callouts, some different swing trade ideas, tutorials, lessons. You can check out profitstaken.com. All right, guys, thanks so much. We'll talk to you soon.